Year to date, the majority of stocks in the S&P 500 have been up significantly, making it harder to find discounted stocks. Today's episode, we are focusing on 3 undervalued stocks near their 52-week lows with some nice upside for the portfolio. As always, we'll look at each individual stock. We'll take a look at both their dividend safety as well as their underlying financial metrics, and we'll run them through the valuation model, getting to both our intrinsic value as well as our acceptable buy price, given that investor margin of safety, and see what implied upside Wall Street have as a price target over the next 12 months. So the first stock that we are looking at is Nike, and as we can see, a buy rating from Wall Street, a double hold from Seeking Alpha and Quant. It is trading right there towards their 52-week low. Now it is down around 17% over the last 12 months, but over the last 10 years, if you have been a shareholder, you would be up 143%, a little bit higher if you were to include those dividends reinvested, and we do see all-time highs sitting just below $180 in 2021. Now, this is a company that does pay a forward yield around 1.61%, and we also note it does trade at a forward P 24.68. As a reminder, the S&P 500 right now is around 22. In terms of the metrics, well, firstly, the dividend safety score, 99, very safe, the highest score obtainable. Market cap, 139 billion, a mega cap company. Now, just last month, we do note the dividend safety score was reaffirmed, meaning essentially their dividend cut is highly unlikely. Now, in terms of the last recession, they in fact increased the dividend during the 07-09 crash. They had negative 6.6% recession sales, above the average of the S&P, which sat at negative 12. We also note they did outperform the S&P, negative 36% recession return, with the S&P bringing in around negative 55. Dividend growth, well, a nice increase last November, 8.8%, above that inflationary target of 4% we always discuss on the channel. Over the last 5 years, over the last 20 years as well, double-digit increases to their dividend, so there's a positive sign. They have increased those dividends for 21 years consecutively, so they're 4 years away from becoming a dividend aristocrat, and they've been paying a dividend for the last 39 without a reduction. Now, for those that are new to dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. Right now, we do have a severe sign of undervaluation, 1.61, in fact, one of the highest yields offered over the last 5 years, versus Nike's 1.04% current 5-year rolling average. In terms of the forward P, another undervaluation signal, when the 5-year average around 31.9. We do, however, note the consumer discretionary sector does sit much lower at 13.3, but as always, we're not looking at any one of these models in isolation. We will conclude shortly on that. In terms of the free cash flow payout, which is what we do draw your attention to, as earnings is susceptible to manipulation by management through accounting, below 60% is basically the target, gives us faith that they can offer those double-digit increases to the dividend. Last 2 years, 42%, expected next year, 33%, so looking very healthy. We do anticipate a nice increase to that dividend very soon as well. In terms of the free cash flow per share, very important metric. You do want to get companies that are increasing consistently over the longer term. That is pretty much what Nike do, although we do see some spots of inconsistency. 121 nearly tripled over the last 10 years. 2024 anticipated to rise sharply as well. In terms of the sales growth, year on year, we want to see at least 3 to 7%, and we do see that, if not a lot more. In fact, the last year, double-digit 10% growth to their top line, a very strong sign of a good business. And when we look at it numerically, they have nearly doubled their top line over the course of the last 10 years, 27.8 billion to 51.2 in the more recent period. Now, returning excess cash is what we'd love to see from companies through those share buybacks, reducing it around 1.81 billion to 1.54 in the more recent year. So always a nice bonus, especially when a company does offer those double-digit increases to the dividend. ROIC, return on invested capital, one of our 7 golden dividend metrics. Double digits, ideally 10% or more is what we want to see, giving us faith management are able to effectively allocate their capital. 21% in 23, 22 in 2022, so very strong numbers. This does make it a very attractive investment to those shareholders as well as those potential shareholders who are looking to add. In terms of the margins, well, 12% on the operating side as a minimum, straddle along that over the larger part, at least that at a bare minimum in 2023. In terms of the free cash flow margin, a lot more healthier. The last 3 years, nice double digit, and trailing 12 months showing 12%, always off to a great sign. Net debt to EBITDA, very, very underrated metric. Earnings before interest, tax, depreciation, amortization, and these are the number of years it would take the company to pay off all of their debt, net of cash on hand. Below 3 is our target. I mean, what this correlates to is both dividend safety and balance sheet strength. 0.19 in 2023, 0.18 expected in 2024. So this company has a very strong balance sheet, and as we saw, a 99 dividend score as well. So let's jump into the valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through every single one of these models. Today's episode, let's get straight into the intrinsic value calculation, and we do get to a value of $122. Now, with the current price around $92, we do start off with a 10% MOS level, and we only execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for the company, we'll buy up to 110, and then we keep going to see what is the margin of safety in today's episode, and we can see it is pretty much trading not that far off a 25% level, which is very strong for a high-quality company if you do believe in it over the longer term. Now, in terms of the forecast, well, over the next 12 months, the analysts are targeting from Wall Street 22% upside with a price target of $112, lower than our intrinsic value. So in conclusion, 25% MOS, 22% upside, but as always, let us know your thoughts as we go along these stocks today. Now, before we do move to the next one, just to let you know, we've released our latest free weekly article, 20 undervalued dividend stocks you do need to consider for the portfolio. If you want access to this or any others, all completely free, do click on that pinned comment below. In terms of this one, a very important one for those that do want to check out what essentially websites and resources we use to review these stocks on the channel. The next one we're looking at is Johnson & Johnson. Now, this is down around 4% over the last 12 months. Over the last 10 years, though, it is up around 49%. Again, will be marginally high if you are reinvesting those dividends. And we get a triple buy rating, Seeking Alpha buy, Wall Street buy, Quant buy as well. As we mentioned, trading right there near its 52-week low. And we do see a nice forward yield, 3.28%, and a forward PE significantly lower than the S&P at 14.2. In terms of the dividend safety, well, another very safe score, 99, market cap 364 billion, a mega cap company. As we mentioned with others, this has also been reaffirmed just a few weeks ago, and we can see a dividend cut is highly unlikely for this company, which has one of the best balance sheets out there at the moment with the likes of Microsoft. Now, in terms of the last recession, well, in fact, they increased the dividend during 07-09, above average growth, and they also significantly outperformed the S&P with their negative 27% return. Now, they did just increase their dividend a few weeks ago, 4.2%. You know how I feel about this. At a minimum, we want to get 4%, but it is a little bit disappointing given over the last 5 years and the last 20 years, we have seen a much higher figure for the dividend. Having said that, they are a dividend king. They've increased consecutively the dividends for more than 50 years, whilst also paying a dividend for a whopping 108 years without a reduction. Now, in terms of dividend yield theory, another severe undervaluation signal, as well as on the forward PE, currently at 14.2. That is below the 5-year rolling of 16.4. And we also note the healthcare sector PE does look higher at 16.1. So let's get to the payout ratios. Now, free cash flow, again, below 60 is the majority we want to see. It has been above that over the last 2 years, so it does make sense why the increases were not as great as we would like to see. 2024, though, it is anticipated to drop down to 54%, which is a positive sign. One thing you do get with this company is consistent free cash flows year on year. Granted, it did dip in 2022, but it has picked up in 2023. 2024, we are expected for this rise to continue on trend. In terms of the sales growth, though, don't expect massive growth with this company. Always understand the type of companies you're investing in and what the expectations are. Always be realistic. 2023, however, 6%. Nice to note on a trailing 12-month basis, though, 11% looking very strong. And we can see over the longer term, they have increased their top line, although marginal, from 74 billion to 85. On top of that, we do note some share buybacks over the longer term. You could argue very minimal, but at least it is some bonus to that consistent dividend that they are paying. We then look at the ROIC, a lot of consistency, very strong year on year. This is one of those companies that is very consistent. You know how they're going to perform over the longer term, and historically they have been very consistent as well. 23% on the ROIC in the more recent year. And when we look at margins, again, consistency is the name of the game. We can see that across the board on both operating margin side as well as the free cash flow margin side. So very healthy numbers there. And as we said, a very strong balance sheet, again, similar to Nike that we just reviewed. 0.25 in 2023, there or thereabouts in 2024. So definitely one to consider for your portfolio at the right price. So let's jump into the valuation. As always, if you do want to grab a copy of this model, you can click on the pinned comment below, getting to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio, as well as those on your watch list. So a 10% margin of safety with the current intrinsic value of 187 comes to around $168. At 15%, around $159, and we keep going as always. Pretty much not too far off now, a 20% margin of safety, which is a very good price for this company if you do want some stability in the portfolio. In terms of Wall Street, well, they see upside of 17%, their price target 177. So right now, around a 20% MOS level with 17% upside, again, for this company that is very consistent. We then move on to the third discounted company. It is CVS Health Corporation with a buy from Wall Street and a double hold. Again, trading right there near the 52-week low with a forward yield of 4.63% and a P which is very low in comparison to the two others we've reviewed today, 8.21. Now, it has been hammered down 20 or nearly 20% over the last 12 months. Over the last 10 years as well, we do note it is down around 27%. The more recent highs of around $108 were seen around 2 years ago. In terms of their dividend safety, well, a nice safe score of 80 with a very nice starting yield. Market cap 72 billion, again a large cap company. We do just see a few weeks ago that they were in fact downgraded. However, they are still sitting at 80, which is safe. And as we can see, a dividend cut does look to be unlikely. So in terms of the last recession, well, nice to note they did increase the dividend. They did have above average growth and they did outperform the S&P, negative 38% recession return. Dividend growth were one of the better ones, 9.9% just in December 23, although we note it was lower on average over the last 5 years, 16% noted over the last 20. And when we do look at it, they have 2 years of increasing those dividends with 27 years of paying a dividend without a reduction. Now, when we get to dividend yield theory, we do note that severe undervaluation signal, the highest yield they have offered over the last 5 years, with a forward P 7.8 sitting below the 5-year average of 9.9, and we do notice healthcare does sit much higher at 16.1. Now, in terms of the free cash flow payout, significantly lower than 40% over the longer term, although we do note anticipated 38% in 2024, still means there is a lot of room for them to continue to grow that dividend, or at a bare minimum increase it in line with inflation. Now, we do note their free cash flow has been a little bit more inconsistent since the drop in 2021, and we do expect this trend to continue into 2024, so something just to factor in when you are looking at both your margin of safety as well as your investment thesis. Nonetheless, they have been increasing their revenue over the last few years. Very nice, 9% in 2021, the last 2 years at 11%, so still a very nice fast growing company on the top line, especially in the more recent period, and we can see in fact they've more than doubled their top line over the last 10 years. Although one thing we do note is they would have diluted your position as a shareholder if you had bought around 2014 at 1.17 billion shares outstanding, more recent period 1.28. When we take a look at the ROIC, we do note it was around 11% in 2022, now sits around 9% in the more recent year, although it does depend on what you want to do. If you want to be industry specific, you could argue around 17% or higher for consumer retailers. For me, I want to see at a bare minimum 10%. In terms of the margins, again, whilst we don't like to see this, we always want to see above 10% at a minimum for consumer retailers. It is something they have consistently done over the longer term in the single digits. The only thing we would say, it has been decreasing, so a sign of operational inefficiency. 4% in 2023. Ideally, we want to see it back up to the consistent 5 to 6% from the last few years. In terms of free cash flow margin, again, in the low single digits, something just to be aware of, whilst we do like to see it around 6% or more. In terms of that net debt to EBITDA, below 3 is the target. Now, 2.94 in 2023. 3.27 anticipated in 2024, so it is expected to rise above that 3, but given the free cash flow payout is very low, as we saw, in fact, below 40% consistently, the dividend does look to be safe. It was downgraded, but still a score of 80 does look to be healthy, just something to consider over the next few quarters, as well as their latest annual report. So let's jump into the valuation. Don't forget, smash that like button if you did enjoy today's episode. Value was provided. Don't forget to also subscribe and hit that notification bell so you're known when these videos do drop. 10% margin of safety then, a buy up to $67.29. As always, let's keep going till it's near that current trading price. And as we can see in today's episode, not that far off, a 25% margin of safety if you do manage to get it around $56. Now, in terms of Wall Street and their forecast over the next 12 months, they see some massive upside. They have a price target of $76.75. 35% implied to be exact, and that is one that we would say out of these three does have the most upside based on Wall Street. However, as always, do let us know your thoughts in the comments below. Have you been adding to Nike, Johnson & Johnson or CVS over the last few weeks? And if you enjoyed this content, let us know. We will do a lot more of this. As always, if you enjoyed the episode, smash that like button, hit that subscribe button, let us know your comments below, and as always, we'll see you all on the next one.